Welcome to the show, everybody. I'm Dangerous Zygos, CEO of Currency Development, and I am joined as always by DJ Universe, Calvin Blingwell, and Dandy Market. Today, we are talking about serious capital because the catalog acquisition space has completely crossed the threshold from a niche retirement plan for legacy classic rockers into a hyper-aggressive institutional asset class. DJ Universe, when Warner Music partnered up with Bain Capital to launch a brand new $1.2 billion catalog fund, did you realize the scale of money we are talking about here?
1.2 billion with a B from Bain Capital tells me everything I need to know about where this industry is heading. That is private equity money, Zygos. They aren't buying music because they love the art. They are buying it because they want predictable, yield-generating assets. But what really caught my eye this week was Mercuriadis launching a new $2 billion artist-centric co-ownership vehicle. $2 billion specifically structured so artists don't just sell their soul and walk away, but actually keep some skin in the game.
See, that Merc play is wild to me because as an active artist myself based out here in Calabasas, the pitch has always been, give us your masters, here is a big fat check, go buy a house and don't look back. But keeping skin in the game? That means if a track I made in Baton Rouge suddenly blows up on a sync placement 10 years from now, I still get to participate in that upside. But you gotta wonder, who actually qualifies for that kind of partnership? Is it just the top 0.1% of superstars?
Exactly, Calvin. You got to stay lit to survive in this game, but you also got to know if you're actually invited to the table or if you're just the product being traded. And it is not just superstar artists anymore. Look at Milk and Honey partnering up with NPRs to acquire producer catalogs. They are going after the actual architects of the sound, the people behind the boards who historically got squeezed out of the big publishing payouts.
That producer catalog play is highly strategic, Dandy. It shows that sophisticated buyers aren't just chasing the household names on the front of the album cover. They are hunting the underlying infrastructure of the hits. A producer might have a catalog of 40 songs that they co-wrote, which translates to a highly diversified stream of micro royalties across multiple artists. That is a much safer portfolio for an investor than betting on a single superstar's volatile career.
And that brings up a massive tension in the game right now. A song that was thrown together casually in 2020 on a laptop and uploaded straight to TuneCore might have 10 million streams, but it looks completely different to an investor than a song that was built like a real business from day one. Investors want to see the plumbing. If your split sheets are messy, they will walk away from those 10 million streams in a heartbeat.
Man, you are speaking absolute facts. I remember the exact moment this clicked for me. It was back when I graduated from LSU with my business degree, and I released one of my first independent projects. About 18 months later, I got a random royalty check from ASCAP for like $4,000 because a sports network used 30 seconds of an instrumental in the background of a college football broadcast. I didn't even know they used it. That was the first time I realized a song isn't just a file on a hard drive. It is an active intellectual property asset that works for you while you sleep.
$4,000 out of nowhere is beautiful, Calvin. But that only happened because your paperwork was clean. If you didn't register that track properly, that money would be sitting in an unclaimed black box fund somewhere. That's the difference between being a creative and being a business owner. A catalog with proper PRO registration, clean metadata, and exact songwriter credits is legible to these big buyers. If you don't have that, you are basically invisible to a Bain Capital or a Warner Music.
Let's break down the actual mechanics of why they price these things differently, because artists constantly make the mistake of conflating their rights. You have two distinct assets here. First, you have the masters, which is the actual sound recording, the specific WAV file of the song. Second, you have the publishing, which is the underlying composition, the lyrics, and the melody. Private equity buyers look at these through entirely different valuation models. Masters usually decay faster but yield higher immediate margins, whereas publishing is the long-tail annuity that pays out for decades.
And let's talk about the real sleeper in the math. Sync licensing. A track that gets consistent TV, film, or advertising placements can generate a much steadier, highly lucrative long-tail income stream than a song that got a brief spike on a streaming playlist and then fell off a cliff. If you can prove to a buyer that your catalog has a history of getting licensed by Netflix, Hulu, or EA Sports, your valuation multiplier goes through the roof, because that is recurring commercial income, not just passive consumer streams.
But here is the danger of this gold rush, DJ. If these funds are waving millions of dollars in front of young artists, the temptation is to cash out way too early. You sell your catalog before it has even had a chance to mature or find its true audience. You take a quick $500,000 today, and then you have to sit back and watch some private equity firm collect $5 million in royalties over the next 20 years off your hard work.
That is the ultimate trap. You got to keep your eyes open. This is why these new models of co-publishing and co-ownership are getting so popular. But let's not act like there's a free lunch here. When you bring in a partner to co-own your catalog, you are giving them a permanent seat at your table. They get a say in how your art is used, who can license it, and they take a massive cut of all that future value. It's a trade-off.
And the market is moving down funnel incredibly fast to find these opportunities. Look at Futures Music Group raising $6 million specifically to target independent label and artist catalogs. $6 million might sound small compared to Bain's billions, but it proves that even emerging indie artists are actively on the radar of institutional investors. If you have structured your assets correctly, you don't need to be a global pop star to attract capital.
That $6 million fund is the perfect example of where the game is going. The big question for artists in 2026 isn't, can I find someone to buy my music? The question is whether you actually built your career like an appreciating corporate asset, or if you handed over your leverage and your legacy before the music even had a chance to show what it was worth. Protect your split sheets, register your works, and treat your catalog like a treasury. Because if you don't value it, some fund on Wall Street absolutely will.